Good afternoon. It's Saturday, April 30th. My name is Dave Coker. This is Talking About Finance. Let's get into it, okay? And once again, we always start out by taking a look at the S&P 500, and my gosh, this is the color you do not want to see, at least in any great quantity like we're seeing here. What a wild week it was here on the leading edge of the Fed's decision and, of course, World War III. Let's see what happened. S&P 500 finished down about 3.3% on the week. It's now down about 13.3% year to date. The VIX, the fear index, traded up to 33.40. It's almost 2 standard deviations above the mean. We don't see a good entry point at this price overall for stocks, but keep the faith. In this market, things can change in a matter of hours, literally minutes. So you've got to be prepared to move and quickly should things change. The 10-year closed this week at 2.93%. It's up 1.4% year to date, starting to become very attractive to certain investors who are cycling out of riskier equities into the safety, the perceived safety of U.S. government securities. Oil closed the week at 104.35. It's up about 2.2% week on week, up about 38.7% year to date. Keep in mind, some people I respect very much says that oil at 130 is almost guaranteeing a recession in the States. We'll see how this plays out. So it seems that inflation's been forgotten and all the attention is on corporate earnings and global growth. We'll have more to say about that later on. Regardless, I'm starting to get the impression the remainder of 2022 is going to be rough. Unless you buy dividend-paying stocks, but we won't talk about that right now. I won't taunt you anymore with that right now. It's possible that we're going to see further equity market declines, but I kind of think they're not going to get severely worse. Famous last words from here. Stuff is really, really cheap. There's some fantastic deals out there. I've been telling a lot of my friends that if we do a sum of the parts analysis of Amazon, for instance, if you buy at Friday's price, you're paying full value for their AWS, Amazon Web Services division, but you're getting everything else for free. Think about that. That's really wild. I've usually got a couple of speculative plays on, but presently I'm fully invested. So my speculative plays are Bitcoin and Ripple. Bitcoin, less speculative than Ripple, but yeah. And I'm still buying more dividend-paying stocks as U.S. cash flow allows. Again, guys, you really don't want to be holding cash at this point. Put it into stocks. Put it into a sensible dividend-paying stock. Forget this garbage. Netflix, Facebook, all this other crap. You're not getting paid to hold it. Why would you buy it? I don't own anything unless I get paid to own it. I'm trying to figure out how to monetize the cats, for God's sakes. Right? In any case, we're starting to see lots of people popping up with lots of stupid reasons about why their stocks are down. Here's a good one, and this reminds us that fundamental analysis is key. I don't buy any stock unless I know exactly what I'm getting. And once again, I invest for only cash flow dividend paying stocks. I don't buy just for the name, and I don't buy for the hope of capital gains. So one thing that I look at a lot is something called dividend cover. And if you don't really understand it, go look on Finance Facts. I definitely did a podcast about it. I'll put it in the comments. But dividend cover is really cool. If the company's paying out $1 a share in dividends, and if they're making $5 a share in earnings, hey, that dividend is safe. But if they're paying out $1 a share in dividends and they're making $1.10 or, God forbid, 90 cents, that dividend is suspect. So I always look at dividend cover for myself. That's the number one rule about why I tend to buy shares or buy a stock. So regardless, what happens when the cost of capital surges? What do you think actually goes on there? Well, it's really fascinating, guys, and we've got the probability of a 75 basis point hike at the June 15th meeting, and you can see it's pretty darn high. Personally, I think it's not going to happen. And we'll talk further about that later on. But it's really interesting to look at this, to see that some market participants actually are pricing it with a 90% probability, 87%. My gosh. Of course, that was before Friday's event. And we'll have to see what happens there. We are seeing, or we saw, an old-time big tech meltdown, a stock meltdown. What I've done here is I've taken a look at market capitalization for Netflix, Facebook or Meta, Amazon, Alphabet or Google if you want to call it that, Microsoft, Tesla, and Apple. It's a collection of tech stocks. Although Tesla likes to call themselves a car company, they're really a tech stock. And you can see here, my gosh, Netflix is down almost 70%. Well, that's been a garbage stock for a long time. What an incompetent management team. My gosh, even as streaming options to consumers proliferate, we're seeing more and more options for consumers to choose from. They raise prices during an inflationary spike. This is going to be a textbook business school case study about management incompetence. And even at the other end, you can see that Apple has only been hit about 11%. So we're seeing this meltdown to some extent, and it's not all bad, guys. I do think things are getting repriced in a very rational way. Not that I would go near Netflix at all, even if it dropped another 30%, 40%. I don't know about that. I just don't like that company. But regardless, some of these companies are actually very well positioned, and I'm starting to get an itch. I did come across some money in my retirement account. Really long story there because I don't look at it that much, but I do have cash flow generating stocks. All I know about the retirement account, 71% invested in gold and silver. Checked it out today and was like, oh my God, I got all this money. So I might be doing something with Amazon, and I'll brief you about that if I do tend to pursue it. We'll talk further about it. So is the Fed being stubborn or realistic? Really interesting question here. You can see that some people are talking about the Fed's made a policy error by raising and actually signaling that they're going to raise at least 75 basis points at the next meeting and perhaps more after that. We've seen this before. We've seen policy errors before. Remember the crash of December 2018? So it's entirely possible that we're going to see them back off. I don't think they're that stubborn. I think they do tend to listen. And when people are bleeding, when Main Street is bleeding, because the stock portfolios have lost value, I think the Fed pays attention to that type of stuff. But we borrowed a lot of money. And it's really fascinating to look at this. It's not really an American problem, although you know, for years I've been complaining about this profligacy in the United States. My God. They could take such better care of people if they maybe cut back a little bit on military spending instead of spending more than the next 12 or 14 countries combined. Just ratchet it down a little bit. Take care of your people. Regardless, you can see this is a global problem. And we saw a huge surge, according to the IMF, in 2020 of global debt. Really wild stuff. I can't remember who put this in the Facebook or probably the Telegram channel. Somebody who was actually with the IMF, one of my friends, and I'm not quite sure. I can't really explain. There's 3 people that work at the IMF that are in the Telegram channel, and one of them put it in. But it's interesting to think about this, that we got this huge run-up of debt and a huge spike in 2020. How's it going to end? I'm not so sure. This is what Goldman's calling the revenge of the old economy. And I love Goldman's research. They're really direct and to the point. Oh, by the way, I just have to say Goldman Sachs has a price target of $30 a share for Twitter. So if you're holding Twitter, take the 54, believe me, right? But in any case, you can see here what we're doing is we're looking at the market cap of Exxon and Netflix, and we saw a complete crash, a total crater in Netflix market cap. And once again, ExxonMobil, and I do own ExxonMobil. One reason, one word can describe why: dividends. I love my divvies. What can I tell you? I love the cash flow. You need to build cash flow as well. Netflix don't pay no dividend, so I'm really not interested in it. But it's really wild to see what Goldman Sachs had talked about, the revenge of the old economy. And we talked about that about a month ago, 6 weeks ago. This idea that the old economy, commodities, investment had been diverted totally towards tech stocks. And look at this. Now we're seeing share prices are soaring for these old economy stocks, and they're cratering for the new economy stocks. And this is interesting. Once again, you know, we always talk about Bitcoin. And guys, I described this on my blog, FinTech Flash News, as epic. Because you may not be familiar with Fidelity. I'm with Fidelity Private Bank. It's a very, very old, very, very conservative asset management company in the States. And for them to move to allow any company that's got their retirement plan serviced by Fidelity to allow employees at those companies, some 28,000 companies, to buy Bitcoin. My gosh, this is absolutely epic. And you just got to ask yourself a question. Why are they doing this? Well, if you read the press release and go on FinTech Flash News, you read the story. They're doing it because of customer demand. Really simple reason. And finally, we'll close with this. And I was surprised to see this. This is pretty good, right? But yeah, Texas, they're moving really quickly. They want to become the state for Bitcoin, for cryptocurrencies in general. They've got some competition with Wyoming. Now, let's not even bring up New York. Oh my God, how backwards they are. But aside from that, you can see Fort Worth is going to be mining Bitcoin, and they're going to actually park mining rigs in City Hall. That is really cool. Speaking as somebody who mines Bitcoin, I totally respect this move. I like this move. This is a very, very appropriate move. Okay, guys, that's it for this week. Once again, bank holiday weekend in London. But if you're in the States, you're going to have an excellent week, seriously. If you got any liquidity, y'all, start to look at some of the deals out there. Some of my prime deals are dividend-paying stocks, and we're seeing some very solid companies paying well over 13, 14% in terms of dividends. They pay monthly, too. So think about it. Dividend-paying stocks. Sit back, get rich slowly. It's the only way to be sure, guys. If you try to trade, you're not going to do it. I don't really mean to discourage anybody, but why do that? Why not wait until you have an income from dividend-paying stocks that you can live off of, and then you can afford to take a little risk? So never fall for that trading idea. Never fall for that. You're not going to be able to do it. Buy some dividend-paying stocks. Get rich slowly. Have a wonderful week. Take care.